What's up, everyone? Welcome to another episode of Real Estate Moguls. My name is Grant Findlay-Shirras, and on today's show, we have an investor. We have the CEO of Pycap Venture Partners, a corporate finance and venture capital firm in Toronto, who has invested in over 16 IT companies in finance, medical, communication, education. They invest in real estate development. They provide construction financing, commercial term mortgages, and a lot more. Check out their website. He is the founder of Sector 75, a tech startup incubator in Toronto. He is a venture finance instructor at the University of Toronto. So I love and we're excited to kind of learn from him today. He is a speaker, advisor, board member for many organizations. He's been featured on Bloomberg TV, BNN, The Financial Post, Tech Vibes, and many more places. So for all the tech startups watching and all the other investors watching who want to get to know someone in the space, okay, who's investing, who's got a perspective on the future of real estate and property tech, he's going to help educate his thoughts, his opinions, and his tips on how to succeed as a startup. So I know I'm excited to talk to him. I hope you are too, to get to know and learn from Stuart Browne. Thanks, Stuart, for being on the show.
Great, thanks.
So why don't we just start with, as investors, when you look at real estate, when you look at property tech, both whether commercial, residential, property management, you must have your thoughts about where the industry is going, what technologies are going to be game changing, what companies may go down with new ones that rising up. What is your opinion on the future of real estate?
Okay, so when we're talking about real estate and we're talking about technology, there's huge potential for tech companies to disrupt this entire industry. I mean, we've seen it many times with a number of other industries like the financial services, transportation with Uber, hotels, etc., with Airbnb. So anytime you look at an industry and you see that this industry is very old school, as they say, and there's a lot of inefficiencies that could be automated, that's an industry that you can say is ripe for disruption and thus ripe for tech to disrupt it, basically, and result in a lot of good investing opportunities as well.
What do you think when you look at those metaphors, Uber for real estate, Airbnb for real estate, Amazon for real estate, like what are some of the things that you think might become a big new player? Okay,
so those are very much like shared economy type of applications which I do believe are applicable, especially when you look at the whole real estate agent market. But there's all these other verticals that Proptech could provide for a really good investment opportunity as well, especially when you look at like development of real estate. So there's this huge push for smart cities, IoT, everything's connected. So when you look at the ways that buildings are built, there's so many tech opportunities in that to make that whole process a lot more efficient, cost-effective, etc.
What did you think of the Google Smart City project?
Oh, Sidewalk Labs?
Yeah.
I think it's a really great idea. I was actually in the market to buy a new property for myself, and I had my eye on Sidewalk Labs as a potential acquisition. But I mean, there's a lot of red tape, and I think there's still kind of people don't know where it's going with that. Like, have you heard the latest on Sidewalk?
I know that they just keep trying to push the project, but I know there's roadblocks for them. That they just it's slowing it down, or the city, the people. Some people don't like it.
I really hope that they are able to succeed in going through the regulation to make Sidewalk Labs possible, because if you look at where they want to develop, it seems like this industrial kind of wasteland that has so much potential. Like, it's right on the water. It's just a barren land that easily can be converted into a livable space and a place that Torontonians will want to visit.
Well, I do know they actually are now having like a venture arm of that whole Sidewalk Lab. So it's like in building this smart city, they want to invest in PropTech companies.
Oh yeah, absolutely.
to further it.
For sure, because it's supposed to be a connected kind of microcosm ecosystem.
Yeah.
And in order to do that, of course, you need to have the tech to back that up. And all of the tech that is backing that up, like all of the Internet of Things devices and all of the analytics that go around that, you need to have that all connected and speak to each other. So it makes for a much more efficient and livable environment.
Are there any, people talk about the brokerage model changing, whether it be residential or commercial. They talk about some of the MLS, or in the commercial, a lack of MLS, some version of an MLS, right, for commercial. Some of these things are going to start to be disrupted, right? Or the agent and what they do could be disrupted. Or the consumer, because they're now totally different. The baby boomers versus millennials are totally different. The way buying and selling is changing. What are some of the major things that you actually think when you look at the brokerage model or the agent or the consumer? Which one do you think is the biggest one that's going to change of those three things?
I think that probably the agent model is going to change. But there's two different types of Proptech companies that are moving forward when we're talking about real estate agents. There's platforms that try to help real estate agents and make their life easier and their whole process more efficient. And then there's the type of platforms that look to completely disrupt agents. And usually when technology succeeds is when it's marrying the human element to the tech element as well. So I wouldn't necessarily say that real estate agents should be fearful of their jobs. I just think that if they have the right mindset and they see it as an opportunity and they try to focus on platforms that could help facilitate their business, make their lives easier as well as that of their customers, there could be some good opportunities there.
Any exciting companies that you've seen or thinking about investing in or are investing in the Proptech space?
I've been a part of a deal that was in the Proptech space on the construction side. So it was a company that had created this IoT device that could measure concrete and in real time how fast it solidifies, so that builders will know when it's ready to start building on top of. So it's these sensors that go into the foundation of a building, and then they could look on their computers or their iPads and in real time see how fast the concrete is drying and hardening. So this was a very interesting company because what's traditionally done is the construction workers will take samples in all these different areas of the concrete foundation and then bring that to a lab and then smash it to see how strong it is. So
are you advisor investing, just looking at it?
I was a part of a deal. I was on an investment committee for a fund that invested into this company, and we were advising on whether or not it was a good opportunity or not. And it definitely it seemed like a great opportunity because, as any investor tries to look for when they're analyzing technology, is it saving costs? Is it making the process more efficient? And is it allowing for greater ease of use? And when there's so much money involved in constructing a building, obviously it's critical to get that element right because it's literally the foundation of your business.
So walk me through.
Of the building.
So walk me through, because this is what startups really should hear. So this deal comes to you and to your advisory committee, and how do you evaluate it? And you guys liked it because of X, Y, and Z. Imagine what would have been a scenario where if these things were different, we would have not invested. So for that same deal, and using this one as an example.
Well, I'm going to talk in generality just for like confidentiality purposes and whatnot. But so when a company comes to me, and so essentially what you're asking, like, where's the line between investing and not investing? Okay, so keep in mind that we are a venture capital firm. So we look at companies differently than a growth capital fund or an angel investor or a public investor. So we have a very strict criteria. There's all these different types of investors out there. So as a VC, we want to see if there's technology that is disruptable. Like, is it disrupting the current way that some sort of activity is being performed? We want to see that that technology has exponential growth potential. Like, is it scalable? We want to look at the quality of the management team. Are they serial entrepreneurs? Have they run a business before successfully, or do they have advisors that could fill in that gap? Other things we want to look at is market validation. That's a huge one. Like, can they prove to us that there is demand for their product or service?
So I know startups, usually they come to the investor thinking, I have cool tech, I can scale, I have a great team, I have market validation, and the investor goes, no, I don't think so. What do you think of those disconnects that you see often when startups come to you?
Okay, so you're talking about specifically market validation. So often entrepreneurs will pitch to me and say, we have interest from Walmart buying our products, or in this case, we have interest from Plaza Corp using our technology. So they'll say a lot of things to show us that the demand is large. So show us that they have that market validation. But a sophisticated investor will not stop at that. They will drill into those statements and try to peel back the layers and find out how real that is. So if you have one conversation with someone who works at, Plaza, for example, that's not a good enough indication that they're interested. Like, you would have to provide specific names of people who you were speaking with. Do they have buying power? There's all these different levels of market validation that an entrepreneur can present, and the stronger their validation is, the stronger their position is to get financed. For example, like, revenue is always the best thing, because if people are actually buying your product or service, then that obviously shows that the likelihood of more people willing to buy it is strong. Failing that, if you have maybe a purchase order, so you have a legally binding document from a potential client signed that says, if you're able to produce this product, we will buy it within this time frame at this price. If you don't have that, then at least get a letter of intent, an LOI. So if you speak with a large real estate developer and you're speaking with the right person who can make a buying decision on your product or service, just get that in writing. It doesn't have to be legally binding, but at least it's somebody, a real human being, representing this customer organization, proving that there is some interest there, as opposed to just verbally making a statement.
Got it. Okay. Let's go even in deeper for tips for all these startups out here, because I know you educate a lot of investors and startups on how to do things. So, we've watched a lot of videos. Most people will read online. They'll have all these different sources about how to raise money. What are your major tips? Like, if you were in the entrepreneur's shoes, these are the things that you see a lot of startups don't do to go raise money, that if you had your own company, these are some of the things that you would for sure do.
Oh yeah, definitely. I mean, there's happy to answer that question, and I hope there's as many entrepreneurs listening as possible. I would say the biggest mistake that entrepreneurs make when they go down this path of raising capital is they're focused too much on the raising of capital as opposed to growing their business. So of course, we work with a lot of entrepreneurs. I give a lot of workshops, even in many different countries. And I just can sense from the audience when they're asking the panel questions or asking me questions in my classroom or whatever, it's almost like they're trying to build a business so that they can raise money from mainly a venture capitalist. And what I say to them, you should be building a business to generate revenue and create value for your customers. And as things evolve in terms of the type of business that you're creating and your business model, then you have to ask yourself, do we need financing? How much capital do we need? What do we want to spend it on? And then after you nail those questions down, you have to look at what type of capital is a fit for us. Because just because you're a tech company and a startup and you have strong growth potential doesn't automatically mean you're a fit for a venture capitalist or a fit for a bank loan or a fit for an angel investor. So after you've focused on growing your business, nailing down the business model, generating revenue, creating something that people actually want, then you have to understand, what type of business you fall into, and what are the different sources of capital available to you. There's no point in pitching a VC if your company is just not VC fundable. We're legally binded within our fiduciary duty to invest within a small kind of criteria, because that's what our investors into our fund expect of us. Yeah. And if it's an amazing company with steady growth and a solid business, that doesn't necessarily mean it's a good VC investment because it doesn't fit into that criteria.
Okay. Now, when startups are having these talks, you hear a lot of things from the investor, because rightly so, an investor's got a reputation and they want to make sure they have good relationships with the startups they talk with, and who knows, they want to make sure that if all of a sudden the startup maybe takes a turn for the better, that they want to be able to maybe get in on it. So, a lot of startups experience that when you go talk to an investor, they'll say certain things as to why they're not investing, and people sometimes get the sense that that's really not what they're saying. So is there anything that you could educate the audience on, like, if an investor says this, they probably mean this, and that's okay, but this is probably what they mean, and help us decode, some of the reasons why investors don't invest?
Okay, interesting question. If investors don't usually, there is this conflict in the mind of investors often, whereas they are somewhat risk averse in the sense that they don't want to be the first money in. Like, they might really like a deal, but it is difficult to raise money when you're going to an investor for the first time and you don't have interest around you in terms of co-investors. Because the investor is thinking, okay, it's a risky position for me to put money into this company. I could rely on my skills and expertise and the skills and expertise of my team, but for me to finance this entire deal, the risk is too high. So there's that side. There's the risk, but then there's the FOMO side as well, the fear of missing out. Yeah. So they don't necessarily want to say no to an investment opportunity. They'll oftentimes say, what you're doing is interesting. Keep me posted on how things progress, and we'll schedule a meeting in the future and see if there's an opportunity to work together. So a lot of entrepreneurs might take that as a no, they're not interested. But really, it's the investor saying, I want to build a relationship, I want to learn about you more. It's almost like a due diligence process as well. I want to see if there's other investors interested as a means to kind of de-risk it. But also at the same time, I don't want you to go out there, raise money from other investors and become this huge success story. Right. And then I have to ask myself, what happened when I had this entrepreneur sitting in my office?
Because sometimes the entrepreneur hears feedback about, they go talk to the investor and say, what's your criteria? And the investor then lays out a bunch of criteria. And the startup goes, I am that. And so then they go to that meeting and they think they have this conversation where they think, I am a fit for you, you're a fit for me. And then all of a sudden the investor basically in some way, shape or form says, no, where do you feel like that disconnect is, in those conversations? How can a startup feel like they're a fit and then the investor then tell the startup no? What do you feel happens in those meetings?
Okay, of course, in this hypothetical example, there could be so many different reasons. So I'll just give a few. Of course, if the entrepreneur feels there's a fit and the investor ends up not investing, there could be so many different reasons, but at the end of the day, the fit wasn't as strong as the investor might have thought going into it. A classic reason why an investor would pull out after the conversation has been going so well is that, well, I could say one of the biggest turnoffs of an investor is if they feel that the entrepreneur is being less than completely transparent and truthful. So, of course, there is an expectation for entrepreneurs to embellish their position and put their best foot forward and try to get the highest valuation as possible and get the excitement around their company as strong as possible. But of course, it's also can be a slippery slide. And when you start going down the process of embellishing what your company is doing, and you start kind of crossing over to speaking about untruths, and that, of course, is a risk of compromising the trust of the investor. And then, of course, once the trust is compromised, the potential for a deal happening is close to zero.
Interesting. Okay. And now,
I'm just saying that's just
yeah,
one example.
yeah.
I'm not saying.
Is there any other common ones? Because my next thing to that is, have you found that sometimes you can maybe tell that entrepreneur is super intelligent, super analytical, super data centric, and they're actually being like too transparent? Have you ever sensed that? And you're like, ooh, you don't need to say like that because that might turn some people off. And
Yeah, you know what? I think okay. So in regards to transparency, I think entrepreneurs should err on the side of being more transparent than they need to, because the likelihood of an investor, ripping them off or doing whatever is extremely low, because we all know how difficult it is to go out and start a business. You're not just going to take someone's idea and just, okay, I'm going to go do that on my own. The likelihood of that is very low. Kind of a faux pas in the capital raising process is trying to get an investor to sign an NDA too early. And there's various reasons for that. So that's not really a good thing to do unless the investor is knee deep in the due diligence process and they simply have to look under the hood and see exactly the secret sauce of your business. At that point, then you can get an NDA signed. But then to address your question before the transparency issue in regards to like what's a potential reason why an investor might not, a very common one, an investor wouldn't put money into a company when the company is being truthful and transparent and they check all of the boxes. It could be as simple as the investor doesn't feel that the entrepreneur is coachable. That's a classic thing.
how does an entrepreneur show that they are?
Being open and receptive to feedback from investors, customers, the market, etc. I mean, it's a lot of what it takes to raise money and be a successful entrepreneur is a balancing act. So you have to be confident, but you can't be arrogant. And you have to be, well set in your ways in terms of you being the industry expert and you being the expert on your business, but you also at the same time have to be open-minded. Because this whole term of coachability, you might think it just implies like, are they going to be coachable from the investors? Like if the investor gives the advice, are they going to take it? Are they going to listen to the investor? Are they going to treat the investor like they're a partner or just go off and do their own thing? So that's one element. But the term coachability also refers to the open-mindedness of the entrepreneur to be listening to the feedback of their customers.
Got it. And maybe there's ways that you've seen companies show that they are that?
Yeah, oh, for sure. Because it's like, look at...
Because in the pitch, in that meeting, like what can a startup do to show that they are open-minded to their market? And open-minded to feedback?
Just the fact that if they're talking about the evolution of their business model, they are communicating how their business has evolved based on what the market has been telling them. So if they say, we started off our business with this hypothesis in terms of how our company would work, and then we kept at it with our customers, and we found out that they were interested in other features of our business or other things that we could provide to them, and so we pivoted to a different business model. That's a great way to show that the entrepreneur is adaptable and coachable and open to what the customers are saying to them.
Now, putting yourself in the startup shoes, sometimes I've even heard that there are some investors that aren't good. There's some financing methods that aren't in the best interests of the startup. And is there any red flags that a startup should be aware about, that if you're seeing this from an investor, if you're hearing this about an investor, or if this is happening in your meeting, or maybe you see this in your term sheet, this is where you might actually as a startup want to pull away and go find someone else to work with? What are some red flags that would help a startup be smarter?
Okay, so in the capital raising process, usually rule of thumb, if it's a proper venture capital fund, they're not going to look to charge retainer or upfront fees to perform due diligence on the company. So if a VC, because that's what their management fees of the investors are paying them to do, is that's their work essentially, is find good companies and perform due diligence, and they're paid by the management fees. If there's someone posing as a VC fund and they're saying, as part of our whole investment process, we have our own capital that we manage, and I'm not talking about like an investment bank or a broker. If someone is saying, we have money, we want to invest in your company, but we have to go through our due diligence process and we're going to charge you for that, that's a red flag. Because I have heard of less than ethical players out there that have created a business model on charging companies upfront retainers with the hopes and the expectations that they are going to invest directly into the business, when all they're really after is just trying to get retainer fees.
Which is different than an iBanker who will charge you a retainer to go help you raise money.
Exactly, yeah, that's a different situation.
Yeah.
In that situation, it makes more sense, because if it's all based on commission and they put a ton of work and put all this value and risk their reputation by putting you, an entrepreneur, in front of their investor group, and then there's something wrong with your due diligence material that he wasn't aware of, that investment banker or broker could have been doing all of this work, and then they're not compensated for it, and they're not compensated. It has nothing to do with their efforts. It's more for the company. So in a situation like that, a retainer could make sense.
Any other red flags or things that startups should be looking for to make sure that they don't pick the wrong partner or do the wrong deal?
Yeah, they should. Okay, they definitely should get legal advice. And when they are starting to draft the term sheet and negotiate with the investors, they have to be cognizant of the fact that it's a negotiation. Mm-hmm. So there's a lot of, most often investors, like VCs, like the sophisticated investors that are looking to make equity investments, are going to be doing it in the form of what's called a preferred share, as opposed to a common share. And so what's involved in this financial instrument is the ability to add a lot of different terms and conditions, and there could be a lot of terms and conditions in this document that could amplify the return potential of the investor and accelerate their control over the business over a period of time. But when an entrepreneur is getting into a deal with the investor, they might overlook those terms and conditions, but they won't be aware of it until it's too late, because they've already signed the legal document.
What are some of the ones that you've heard or seen?
Okay, so first and foremost, I teach this at MBA school and Master of Finance and stuff like that. I'm not a lawyer, but I'll just give you my own perspective. And I'll just throw out the caveat that it's a negotiation, so both parties have to, be mature and come to a deal that both parties feel is fair. That's the end goal. Yeah. If it's a good investor and a good company, that's what you're after. But like any sort of negotiation or sales process, it makes sense to try to get as much as possible for as little as possible. So it doesn't mean an investor is trying to, take advantage of the situation in a bad way. It's just all part of the business of making a financial transaction happen. So with that, there's some terms and conditions within a deal that can Some of them are related to dilution. So some investors will say, okay, I want terms in the preferred share agreement that protects me from being diluted in the future. There's also something called a milestone financing. So if you're an entrepreneur and you're pitching me as an investor and you're saying, my company has like 100 customers lined up, we're going to close them in a year, our revenue is going to grow 10 times over the next 6 months, and you're giving all of these projections to show us that you have, the hockey stick curve and to get us excited. That can be a double-edged sword, because you have to say things like that to get the investors excited to put money into your business and buy into the vision. But at the same time, the investors will come back and say, all of you, these things that you say you're going to achieve, we're going to get that in writing, and we're going to map those out in terms of like a milestone financing approach, whereby you could be looking to raise $1 million from me, but I'm not going to give you $1 million day one. I'm going to give you maybe $300,000 to get to your next milestone. And then we want to see if you're able to make those achievements that you say that you're going to. And then if you fall short of that, then that could be an opportunity for the investor to take more equity or redraft the terms and conditions and withhold money from you. So that's another opportunity right there for investors to take more control of your business, or once again amplify their return potential. But entrepreneurs shouldn't necessarily see this as a bad thing, because as I mentioned, it's a negotiation process. If you're sitting at the table and you're pitching me your company and you're saying my company is valued at $10 million and I need to raise $1 million, and I'll say, and if I say to you, I think the valuation is too high based on your track record and your projections, or our projections that are a little bit more conservative.
Yeah.
Then we could say, okay, well, if I'm wrong, why don't we add these terms and conditions into this preferred share agreement that will allow me to show you that I'm signing that I'm going to make these achievements. And if I don't, then I'd be happy to go back to the the negotiation table and figure out a way for you to get more value than you had when we entered into this agreement.
How do you recommend startups value themselves?
There's a number of different methods. I mean, they're all online that you could Google. Yeah. My advice would be to use as many methods as possible and show a level of conservatism, so you're not trying to overvaluate your company, and get the average of all of them, and then maybe show a range too.
Right. Okay.
Just as much work as you can put into the valuation of your business, the more power you're going to have to back up why your company is valued at a certain way.
Interesting. Okay. What are some of the things that, as you grow your fund and your business, what are some of the challenges and needs that you have that maybe someone watching can help you with?
Well, we're always looking for good deal flow. So if an entrepreneur is watching this video and they've listened to our conversation and they feel, okay, I meet all of these criteria that Stewart and his venture capital firm are looking for, perhaps I should be pitching them. Yeah. And in a situation like that, I'd be more than happy to take a glance through their investor presentation and see if it's worth having a follow-up meeting. Cool.
Any particular kinds of companies, industries, things you want to see more of?
That's another interesting question to ask to a VC. I mean, VCs don't like to pigeonhole themselves too much because then you have the FOMO situation happen. They don't want to miss out on deals that someone might be listening to that don't fall into that criteria. But generally, we're looking for companies with technology that is in artificial intelligence or can support it. So big data, IoT would be a fit as well. The verticals that we're looking for are, we like agriculture, we like healthcare, we like financial services. But if there are interesting companies in the Proptech space or in the clean tech space that have, that are heavy on the software side, I would be very interested in taking a look at that as well.
And how can people get in touch with you?
The best way would be to, they can visit our website at www.pycap.ca, so that's pycap.ca, or they can email us at info@pycap.ca.
Cool. Give Stewart a shout if you are in Proptech and you use some cool deep tech, AI, machine learning. Thanks very much for being on the show.
Great, thanks a lot.
As always, guys, if you want to learn from leaders in the industry, investors in the industry, because you want to be great in real estate, whether you're an agent, a team leader, a brokerage, or a startup, then subscribe to the YouTube show and the podcast. Click that bell icon on your phone, and we'll see you next time.